So I had a doctor. My doctor was amazing. Like, so there was a period in time in my life where I was like, it was crazy, right? I was running 2 different companies. I was running this other firms. I wasn't sleeping. We had really small kids. And so I was the doctor. I'm like, hey, I got to, help and everything. This doctor was so awesome. He's like, this drug's for narcolepsy. He's like, this one's for this. And he a cocktail of freaking performance. Like, I'd go not sleep for like 3 days, and it was insane. He was the best doctor ever. He went to prison, so I didn't get to keep seeing him. But
welcome to Drunk Real Estate. Grab a drink and enjoy the show.
Hey there, welcome to Wayne Gretzky 99 episode of Drunk Real Estate. You didn't like that one? All right, I'll do it again, Mauricio. Sorry. Hey there, welcome to episode 99 of Drunk Real Estate. I am Kyle Wilson, Ashley Wilson's husband, and I'm joined by all three co-hosts, guests, whatever, my buddies. How's it going, guys? Mauricio, what's up, man?
You should have started with some reference to I don't know, Wayne Gretzky or something, or maybe 99 balloons, red balloons or something like that.
I said Wayne Gretzky and you balked at me.
I didn't do anything, man. I think you're just projecting on you. I don't know what's going on with you today, but I just smiled, or I don't know what I did, but you
I'm angry they haven't legalized marijuana yet in Pennsylvania. What are you drinking, Mauricio?
I got another one here, but I'm going with a little white wine, a little half bottle, because tomorrow, a little La Creme. Tomorrow I got to get on a plane at 5 a.m. and the host of this event declined to bringing his private plane to pick me up. So I got to go slop it in commercial and get on a plane at 5 a.m. tomorrow to make it out to an event. So
wait, is the implication there that you drink a whole bottle of wine usually for this,
for sure.
This podcast?
At least.
You're just doing a half today, keeping it light. Nice. Jay, how's it going, man?
Good. Mauricio, you left me hanging last week.
What happened?
You were supposed to come out to the conference that I was at. We were going to speak together. We were going to hang out for a few days. You were going to take me to sushi.
I got sick, man. What do you want me to do?
Oh, you didn't even go, Mauricio? I didn't know that.
He not only did he not go, he waited until after he was supposed to be there to let anybody know.
That's not true. I let everybody know the day of the travel, but I handed you the thing in a silver platter.
Yeah,
I gave you my coveted spot with the host of the event with some amazing people, and this is your. You should be. I didn't even get a gift. You should have given me a thank you gift or something.
He'll send you a Drunk Real Estate mug. What are you drinking, Jay?
I am drinking. I don't know. I grabbed a random bottle that was at the bottom of my wine rack.
A gift from someone that you don't know who gave it to you. A
gift from somebody I do know who. I'm not going to say.
It's a shitty bottle of wine. Is that what you don't want to say?
No, this one. No, He's a shy person.
So this is why, by the way, this is why when I give bottles of wine as gifts, and I know you guys haven't had this experience yet, but when I give bottles of wines as gifts, I actually write the message on the front of the bottle and sign it so that when they drink it, they remember who it's from.
I'll have to take your word for that.
Yes, because you're never going to see that in first person.
And that's also unopened, Jay. So I assume every week, whenever you show a bottle of wine, you then take the time during the episode to open the bottle, as opposed to just opening it before.
Dave, come on back to me. And
I'm usually 3 glasses in by the time we come to this episode.
AJ, what's going on? So you're looking good, buddy. I like the pool casual outfit. You look like you should be going onto a yacht right now, showing a little arm hair. I like it.
That's where I should be going. You're absolutely right.
For once.
It is. And our studio doesn't have a freaking heater, so if I start sweating, you'll know why.
Is that a chocolate chip mint shirt?
It does look like chocolate chip.
Yeah.
Wow.
It's good. Look good.
Good call.
I like it. All right, let's get into this.
What are you drinking, Kyle? What are you drinking?
Oh, I'm being very. I'm just going with a clear here.
All right, go.
I know you were going to make fun of me, so I was just.
You look very enthused for this episode.
Yeah, I'm sorry. We'll rally. We'll get this going. And you know how we're going to get this going? With an economic update, because it's been 2 weeks.
Can I just say, wait a second. This is a good bottle of wine. I'm very surprised here.
We appreciate that, Jay. I know our listeners appreciate you actually pouring into the glass this time. It silenced the critics.
I liked it. I liked it. You hear it. It sets the tone. It's like,
Yeah,
let's go.
smell it.
Dude, I think that's an indictment on all the other wines he's opened up from his other people that have given him gifts, because apparently they all sucked. And so now you finally have something that's good. So if you've ever given Jay a bottle of wine in the past, apparently this is the first one he's liked.
Well, let's get this going with well, we got to let Jay take his first sip, but after he does that, he's got to give us an economic update. It's been 2 weeks. We haven't had a Jay economic update. So Jay, give us a bunch of data first, and I will sit here and ignore everything you say just because I'm waiting for you to mention the jobs report so I can just go nuclear on it again.
I will, in that case, I will start with the jobs report.
No.
Okay. Then I'm going to start with the other stuff, but the jobs report's the big one. But I'll start with the other stuff. So today we got the NFIB optimism index, which is basically the small business sentiment index. It's a survey of small business owners and how they're feeling about the economy and their business, et cetera, et cetera. We got a great reading today. It was the highest reading since 2002. I think it was like a 98.2, where 100 is about average. And it turns out inflation is no longer small business owners' biggest concern. Now it's taxes. Not sure why they're concerned about taxes, but apparently that's the biggest concern. So there's a good thing. So small business optimism is good. Actually, last week, I don't have the data in front of me, but consumer sentiment data last week was actually on an upswing as well. Americans aren't feeling as concerned as they were a few weeks and months ago, which isn't surprising. There's a lot less uncertainty these days with all the stuff going on with tariffs and imports and that sort of thing. So that's consumer sentiment. Construction spending, we got those numbers last week. Construction spending was down 0.4% last month, 0.8% the month before. So not surprisingly, because we know that we've talked about this on this show, but basically there's less building than what we need and than what we've had for the last couple of years. Some of that's been construction costs and labor costs. Some of that has been land costs, but basically construction is slowing down. Good information on hourly wages. We saw some hourly wage data, so up 3.9% for the last year, which is great if you believe that inflation is really around 2.5, 2.6%, which we all know the government's numbers are wrong. But still, I mean, that's the number we use, 2.5, 2.6%. That's the number we all have agreed to trust. If hourly wages are going up 3.9%, that means wages are up about 1.5 points above inflation, and that's what we like to see. We want people making more money compared to inflation, so their spending power actually increases. So that's really good news. Tomorrow we have CPI inflation. So when I say tomorrow, for anybody listening, the day this is released, it was yesterday. So by the time this comes out, we'll know what May CPI inflation looks like. On Thursday, the day this is released, we'll get PPI, which is wholesale inflation. So we'll see what happened in March with inflation. But last month's inflation numbers were pretty low. That's good. And that's really an update on everything other than jobs. So can I jump into jobs?
That's the only update. No other update other than jobs?
Anything else? Anything we want to talk about with any of that stuff?
I just was reading earlier that the odds or the market is now predicting lower or not as many Fed cuts as they were before, which I think the expectation of the market is that the Fed's only going to do one cut in 2020. I think you've been on board with me. I think maybe not, but I've been I don't think there's going to be any cuts this year. Maybe even going up, but apparently they went from 7 cuts at some point last year, and now the 4 cuts to now it's 1 cut.
That's because the job market is so strong, right?
Well, we'll talk about that in a second, but let me address what Mauricio said. So this is next week, a week from tomorrow, so next Wednesday, the Fed meets to talk about a rate cut, and it looks like the market is pricing in over 99% chance of no rate cut next week. Move out to July, and it's about an 85% chance of no rate cut. Move out to September because there's no meeting in August, and we're finally at over a 50% chance of a rate cut come August. There's actually a 60% chance of a rate cut, with about 8% of that being a half-point cut come August. September. So certainly nobody thinks there's going to be any rate cuts through the summer, but then moving into September, October, and December, people are thinking there's going to be at least one cut coming.
Like Powell wants to cut, he just can't. Like it's the how can you cut right now with everything going on with the uncertainty with tariffs, and like it could make you look like an idiot because all of a sudden something changes. So he's just going to hold strong. But that I think that's the irony of this, is that like in any other situation, I think Powell would have already been cutting, and yet Trump is like, you got to cut. And he's the one who's preventing him from cutting by putting on these tariffs. So I just think it's a little bit
I don't
ironic.
think the tariffs make as big of a deal as you think. I was under the boat even last fall that I didn't think in 2025 they would cut. And I think it's like, how could you? Because of spending. So the government spending is the whole reason they couldn't cut rates prior. And we just got a spending package that is just as big, if not bigger. So I think they're looking at this going, the money supply is not shrinking. The money supply is the same as it was when they increased interest rates to shrink the money supply. I think tariffs, like, I think not that it's not a non-issue, but I don't think that's the driving reason for the Fed, because they even mentioned that we're taking that into consideration, even if you took tariffs, like all the numbers from tariffs off the table. I think it's government spending that is the problem.
To Kyle's point, though, there's still that little bit of uncertainty around, are tariffs going to cause inflation? So right now we have inflation data through April. In April, we basically didn't start to see a reduction in inventory coming from overseas, or we just started seeing it, but most of it, and I don't know what the impact is. I mean, I'm not seeing empty store shelves in my area. I don't know if you guys are seeing empty store shelves in your area, but there is talk of some limited supply for some items. And so we could see inflation in May. We could see inflation in June. We don't really know. And if I'm Powell, I'm probably going to wait and get a little bit more certainty. But I do agree with you, Kyle. If in any other situation, I think we see a cut by now. But it looks like it's not going to be this month.
All right, let's talk about the ridiculously strong job growth.
Okay. So when we talk about jobs, so what we got on last Friday was the April employment report. And so that basically consists of two surveys. One's called the Establishment Survey, where they go out and they talk to businesses, and businesses talk all about all the jobs they created or cut. Second is the Household Survey, which they go out and they talk to regular people like you and me, and they find out who says they have jobs, who says they don't have jobs, or not looking for jobs, or are looking for jobs, whatever. And so we have these two very different surveys. Again, Establishment or Business Survey is focused on like the job situation, and the Household Survey is focused on people and employees. And so the headline number, the one that tends to be the one that everybody looks at just historically, not for any good or bad reason, it's the Establishment Survey. So they look at what the businesses are saying about the number of jobs that are being created, filled, cut, etc. And that headline number last month was lower than recent averages. So we were down around 139,000 jobs created last month, but that 139,000 is still reasonably strong. There are people who were predicting, I'll go on record to say I was one of them. There are people who were predicting that by now we'd probably be seeing close to zero or even negative job creation.
Why is that strong though? Like in comparison to what? Like that is barely just keeping up like that. Like people act like zero is the baseline. Like we don't have a growing country and a growing economy and people like a growing population, and like that zero would mean that nothing's happening. No, we need like somewhere between 100 and 150 just to keep pace. That's the zero number. So we're basically 139,000 jobs is zero. So like when we say strong, no, we're at zero.
Well, let me be clear. My definition of strong, and most of the definition by most of the people that talk about these reports, is relative to historical. relative to what we've seen over the last 6 or 12 months. And last 6 or 12 months, the number that comes out every month, I'm not going to say the number that sticks around, but the number that we see every month is somewhere in the 150, 160, 180,000 range.
Is that before the revised down or before or after?
And I'm getting to that. I'm talking about the number that comes out every month, not the number that ultimately ends up sticking, the revision. So for most, let me step back here. For most economic data, what we have is we have the data that comes out the day it's supposed to come out, and then a month later we get a revision, 2 months later we get a revision, and a year later we get another revision. Because all this data, we don't necessarily have all the data at the time that we release the first.
But half of the time it gets revised up and half of the time it gets revised down, right? So that kind of evens out. Is that how it works?
So it really depends on whether the economy.
3 times, Mauricio, it's been revised up 3 times.
No, that's not true. 3 times recently. But here's how, let's talk about how the survey works. The way the survey works is people send in their information. They answer questions. And so if you send in information today, you're going to have a certain answer to your question. What if you wait a month or 2 to respond to that survey? If the market is going down, if employment is getting worse, there's a good chance that a month or 2 from now, the survey data that people are submitting then is going to look worse than it is today. But because it's on a survey that was mailed for this time period, it's going to get.
Are you making this up? Are you just like, is this just speculation of how theoretically things could happen?
No, this is how it works. So what they do, the reason we have a revision a year from now is because data that was for surveys that were sent out last month is going to trickle in over the next year. People don't always respond to those surveys immediately. And so if somebody answers that survey in 6 months, that's going to factor into the revision a year from now. It's not going to factor into the data release last week because they haven't turned it in yet. And so if the market's getting worse, then it's very likely that in 6 months from now, when they turn in that data, it's more likely they're going to have negative things to say. I lost my job. I'm looking for a job. I can't find a job.
So when they get revised down, it means that things are getting worse?
Typically, yeah. So if you look, when was the last time we saw major revisions down? 2009, 10, 11. When was the last time we saw major revisions up? 2015, 16, 17. And so there's a very strong correlation with where the market is heading and whether jobs numbers are getting revised up or down in the subsequent revisions. And so it's actually a good leading indicator of where the market's heading. If you look at these revisions, it gives you a good idea of, is the economy getting stronger or weaker? And the fact that we've seen revisions down for the last several years has been a really good indication that the market isn't nearly as strong as what a lot of people like to think. And so
I'm gonna push back on that because the problem is we're under. So, okay, if we're talking about revisions down off of what? So we are, historically speaking, we're in a really tight job market. So even if they're revised down, so let's say we have unemployment rises, and okay, that's bad. Well, is that bad though if we are beyond capacity? Meaning if if the average is a 6% unemployment rate and the Fed actually wants it to be back more in line with something like that, and we're at 2% and we have labor shortages, to have unemployment go up, all of a sudden by however much, that doesn't necessarily even mean though that the economy is weak, right? And I think one of the things that we've had is we've been kind of in a labor crisis. So the long-term employment rate, I think it's 6%, 5.5.
It's closer to 5, but yeah, it's definitely higher than it is now.
Yeah, and so we're moving from literally a year ago, we were having labor shortages. Stores were closed. You couldn't go to restaurants because they literally didn't have workers.
Well, but AJ, that's also just because of the nature of the survey. Like the nature of the survey is they ask, are you working? They don't say, how much are you working or where are you working? They just say, are you working? And if the answer is yes, then you go to employed. If the answer is no, then you go to unemployed. And the ability to get a quote unquote job right now, like I could just go and sign up for Uber and start driving and I have a job. Like that didn't exist back in 6%. If you wanted a part-time job, you actually had to get hired back then or go create a business. Like there was no gig economy.
Is that the reason there's a delta? Because I've always been, this is a question for you guys as a student. But like the ADP payroll report, right? That was way lower. Like that comes out a couple days before the jobs report, and that came out in the high. I think it was 37,000 jobs created per the ADP. I would argue that the ADP, if I was going to have to pick one of which one would be more accurate, I kind of would tend to be the ADP ones. I know they measure different. They measure different things. I get it, but they were like they're off like by 100,000. 100,000.
So you saw, though, I assume that 90% of all the jobs gained of that 139,000 were in two sectors, right? It was healthcare and social assistance. It was 90% of the jobs gained. I actually saw a theory that I forget where I heard it, that basically what's keeping our economy just going is the fact that we have so many baby boomers retiring and getting older that the healthcare industry is just propping up our entire economy. Like that there's so many people who need extra healthcare, more so that sector's growing so much. And just by necessity, it doesn't, people are going to get sick regardless of recession or not, or how the economy's doing, that it's propping it up, which I thought was an interesting theory.
Let's talk. How about this? Can I structure this conversation a little bit? Because we got this headline number. I mentioned the 139,000, which we can argue good or bad. The market believes
that's the highest ever. 139. The next highest is 136,000.
Like of all times, or in the last year?
Here, let me show you. Got it.
We've had a 200,000 job.
Yeah, we had higher last month and the month before.
I'm talking full-time employment.
Oh, okay, full-time.
Full-time employment with the latest numbers that came in. We're talking the beginning 2025, and this doesn't take into the new numbers, but we are the highest ever recorded. It was in January of 25, and then it's come down from the highest just to the previous highest before that in 2023 ever. So full-time employment is, I mean, we're at like super high rates here. So I think that although we may be looking at it, and I understand that there may be a difference in, gig work, everything else, we are still at the highest levels we've ever seen.
Theoretically, that should always get higher, but yes, I agree. That's interesting.
Yeah, but the point is, even over the last 3 years, look how much higher that is. So even in the short term, it's significantly higher.
So part of the reason that we're seeing that right now, and that's a good thing for the economy. It's a good thing for people to have full-time employment. Part of the reason we're seeing that is that, as you mentioned, AJ, a few months ago, a year ago, there was something like 9 million open jobs, 10 million open jobs for about 3 million people that were looking for jobs. So it was literally 3-to-1 job openings per person looking for a job.
Yeah, the good old Jolt survey, the most reliable of all the surveys.
I know you love the Jolt. These days, it's closer to 1-to-1. It's about 1.1 to 1. So there are a lot fewer job openings right now. So there's a lot more competition for those jobs. People don't have as much choice in their employment, and so they're going to jump at something, and people are going to jump into a job that may not necessarily be the job they want, but because they're concerned about not being able to find the job they want, they're going to jump into something full time. But okay, so if it's okay, again, 139,000 number, again, good, bad, we can argue it all day. Again, the market thought it was good, has responded well. Everybody's happy.
The market just responds to expectations, though. The only reason the market thought it was good is because it expected was 126 and it came in at 139. Like if it was expected at 150 and it came in at 139, everyone, like the market would have thought it was bad and it would have gone down.
That's fair. But again, it is what it is.
Labor cost is also the highest it's ever recorded.
Not that, a different number.
All right, go ahead, Jake.
Okay.
Go ahead.
But looking at the data, I found, or I've seen 4 things that indicate to me that things aren't necessarily as strong, or it not necessarily in line with this top headline number, this establishment 139,000 jobs created. Number one, and I'll let. Well, no, I'm going to save number one for second because I know Kyle just talked for the next half hour. So number one I'm going to talk about is that, this establishment survey said 139,000 jobs were created last month. If you look at the other survey, the household survey, the one that that surveys people and asks them, do you have a job? Are you looking for a job? Are you unemployed, employed, not looking, etc.? What we saw was that last month, 625,000 people said that they've left the workforce.
I heard even higher. I heard it was like 695. But
maybe, yeah. So I saw 625, maybe it's higher. But basically, that means somewhere over 600,000 people did one of a few things. Either they left their gig work, so they're no longer driving for Uber or DoorDash or whatever. Number two, we lost probably about 20 to 25,000 federal workers who haven't yet stopped getting paid, so they're not looking for new work yet. So they haven't really said that they were unemployed, but they're also not looking for a job. But then the biggest category of people in that group is likely the retirees. We can expect over 4 million retirees per year for the next several years. And this, when the labor force is deteriorating, when the labor force is compressing, we aren't necessarily going to see that in the headline number. The headline number doesn't tell us about the people who aren't looking for jobs, who have decided to retire or give up. It just tells us about the jobs that are being created and destroyed. And so looking at this household survey, this is scary. And this is something that indicates there's going to be an issue in this country at some point in the near future, because we are losing workers so much faster than we're adding workers to the economy, and that we're creating jobs.
It's such a problem. The spread to 2030 to 34 is 10 million shortage. We're 10 million workers short in the United States.
Yeah, but that's a good thing, though, because with AI coming on board, we're not going to need them anyway.
AI is literally the only thing I think that's going to save us from our labor crisis, because it is so bad. I mean, the economy, and this is the problem with inflation. This is the largest driver of inflation that we can have. Salaries are up. The economy can be doing bad, and yet we have a full workforce. Not because that's not a signaling necessarily even that the economy's good. It's because we just don't have workers. So all of a sudden, when the economy contracts and yet people can still get jobs and you have full employment, how do you squash inflation without debt reduction and money supply down? So typically, and I think what the Fed's thought, because this has happened every time you raise interest rates, guess what happens? Employment goes down. That didn't happen. And employment has gone up and stayed up. And it's not because necessarily the economy is great. It's because before that, there was 3 to 1, like Jay was saying. So all of a sudden, if the economy's doing good or doing great, we could have serious problems where all of a sudden you have 4 or 5 to 1, because every day 10,000 baby boomers are retiring and we don't have people to fulfill those jobs. And so that is a crisis that it's like a monetary system that has never happened before. When you're looking at our monetary system, we should be able to raise rates, contract the economy, slow down demand, stop hiring, which the Fed doesn't want to overtly say it, but people going bankrupt and not having jobs is how you tackle inflation, because you lower aggregate demand and you get rid of money supply. If they can't do that by raising rates, that's a problem.
Yeah, but there's an even simpler correlation, and that's simply labor participation, the percentage of people that are actually out there working, and GDP, growth of the economy. When we have fewer people out there working, filling jobs, being productive, we have slower growth in the economy. And
unless the productivity rate goes up, which
that's the hope with AI.
Yeah, and that certainly could happen, but normally speaking, productivity rate isn't going to spike if just because labor participation goes down. Now, absolutely, AI could be the.
I don't think it could be. I mean, it's already. I mean, we should obviously dedicate a whole episode to that. But I mean, the amount of companies, even my own, like in my own profession, like the amount of companies out that in the past would need 20, 30, 40, 50, 100 people to work on, and now it can be done by 3 because of AI is just redonkulous, and it's just only going to get worse or better, however you want to call it. And in the legal fields, what I've been paying attention to, it's even more fascinating, because I don't even know what associates are going to be doing here in the next 5 or 10 years, because it's like, I'm not sure you need them anymore, because the technology is already to the point where they're replacing. It's not like they're replacing it, but instead of needing 10 employees, now you only need 6, and then you're going to need 2, and then you're just need one person who's overseeing the whole AI shop. So we need to talk about that in the soon.
Mauricio, go onto Twitter and look at the thread that I put out for all our data on labor force and AI and the changes in it.
Is Twitter the same as X?
I think so. I really don't know, actually.
Okay, so let me jump to number 2, and I'll hand this one over to Kyle for him
It's
to
going to be a
rant.
7-hour tech talk. We're on number 2.
Yeah, I can skip 3 and 4. I can do here's 3 and 4 real quick. Manufacturing lost 8,000 jobs, which doesn't necessarily bode well for the idea that short term, who knows what's going to happen long term, anything can happen, but short term, tariffs aren't driving manufacturing back to the US, at least not yet. And weekly jobless claims, which we're looking at employment data from April at this point. That's over a month old. We see jobless claims, people that apply for unemployment benefits on a weekly basis. And so we have data that's a lot more up to date every Thursday on what's going on in the job situation. We're starting to see those unemployment claims start to kind of creep up week over week. And so that's an indication that that what we saw in April could be deteriorating a little bit in May, not necessarily like really concerning at this point, but we are seeing a trend up. Okay, but here's the big thing, and this is the one I'm going to let Kyle have fun with. We saw some job revisions for 3 months. We saw, March and April job revisions. So March, we were revised down 65,000 jobs. So we went from 185 jobs created in March is what they originally told us. Just like they said 139 this month. In March, they said 185. They're now saying, nope.
228, actually, I read 228 and was revised down to 120.
185 is what I have. So
here's the headlines for the March jobs report. This came straight from the White House. Jobs, jobs, jobs. Explosive growth in March as Trump economy booms. That was based off of a 228,000 jobs report. The latest revision is down to 120,000 jobs. Do you think that's what the report or the headline would have been? And do you think anybody even mentioned that?
Here's the actual report. So March was revised down from 185 to 120.
Yeah, so 185 was the after the first revision.
Got it. Okay.
It was at 228 when it was reported.
Got it. Okay. So even worse. So an even bigger revision down. And then April was revised down from 177 to 147. Which
will probably get revised down again.
So we're over 100,000 down from the original reporting to today, those 1 and 2 revisions, just in those 2 months, 100,000 in 2 months. If you look at the full year going back to last March or so, the estimate is that we're going to see revision of over 1 million jobs. We saw 1 million the year before, or 900,000 the year before. So, I mean, it's just crazy how.
Why doesn't the market react? Because to Kyle's point, if instead of saying 228,000 jobs back in however long ago this was, they would have come out and said, "Oh man, we only got 120." You would have seen the markets react significantly to that number. But when it happens 3 months later,
because it's a footnote. Like no one reports on it.
These guys know. It's not like it gets snuck through. They know what happened yet, and the market.
Yeah, but Mauricio, if I tell you your kid fell down and scraped her knee this morning, you'd be a little bit concerned. You'd be like, "Oh, is she okay?" If I told you, by the way, your kid fell down a year ago and scraped her knee, you'd be like, "Well, I would have known if there was some."
Not only that, she fell down and scraped her knee 2 months ago, but your other kid this morning bumped their head and is currently bleeding. Which one are you going to care about? Like that's
yeah,
just
but you're also
nature
telling
of
me that suddenly like $10,000 left in my bank account from a year ago that I didn't know about because I had to treat the injury. It's not what it is;
it's what it means. And I think that that's the key. I think that if there was something that would change the fundamental belief in a major way, but when you revise the numbers every single month, and guess what? Unemployment doesn't spike up, then it's like, okay, whatever. This is how it works. I mean, how long has it been since they've revised the numbers down every single time? I mean, it's like, and unemployment's not skyrocketing, not doing it. So I think the market looks at it and goes, that's the exact same thing that's happened 15 times in a row.
If you actually look at the Kansas City Fed's labor market conditions index, There's a whole thread on it, like the correlation between that and the actual unemployment rate, and they usually correlate pretty well. But right now, that index is implying we should be over 5% for the unemployment rate, and like those, like if you want to take actual stats like that versus these surveys where they call up people and ask if you're working, and they only get a 30% response rate these days, and they have to extrapolate that across the entire economy.
What's the problem, though? How do you get to 5%? How does the percentage go up when every day you're losing 10,000 people out of the workforce? Do you know what kind of unemployment has to go when you are losing that many people to create an increase in percentage? The population is getting less.
The denominator is getting smaller in that equation. So
they factor that in, though. That's supposed to be factored in, and then we add jobs on top of that. So
it is factored in, but it's still math.
It's still exactly. So it's like what to the point is unemployment and to Kyle, your point, like to Kyle's point, a 5% unemployment today is not the same as it was 10 years ago. A 5% unemployment today versus 10 years ago, when you have millions more workers in the workforce, that's different.
What's the number? Let me just look it up. I mean, we talk about 10,000 people leaving the workforce, but obviously we have the echo boomers. I mean, we've got people, not the echo, I guess not we're that, but we've got the new folks coming in to the labor force as well. So we're not just losing 10,000. The question would be, how many are we gaining every day or throughout the year?
If only there was a way to like bring people from like other countries who are working age into our country and let them get jobs. Like we got to figure out some way to do that. The problem with that is
you're losing baby boomers with full-time work that have worked in jobs for 40 years. You're not replacing them with an immigrant that comes across the border. That's not how it works. So when you're talking about labor that is skilled labor that has been working in these jobs,
you're assuming that all the immigrants are coming across the southern border and walking across with just the shoes on their back. Like,
no, I'm not assuming they are. We see by the numbers, the vast majority of them are.
Kyle is saying that there are other immigrants coming from the northern border on horseback who want to be Mounties.
Or with hockey pucks.
And we just need millions of them.
Well, or we could do what Canada does, which, if I could toot Canada's horn, when they develop a policy and they decide, okay, hey, we need more jobs in this sector. Or let's say they have a project. Hey, we're building a Golden Dome radar station up in northern Canada. We need people with that specialty. You know what they do? They have a special provision where they can fast track immigration for people who have that specific skills and come in and take those and do those jobs.
So easy. Why America doesn't fast track immigration is beyond me.
Maybe we could create a program. We could throw some letters around it, maybe an H or a B. We can have a number in there, maybe the number 1. Like, I don't know, just make up something and
or you know what else we could do, Jay, is we could actually get them before that, and we could bring in smart people from other countries and give them these, like, I don't know, like a visa or something to go to our smart schools and learn. And we could increase that. That would be good too.
So I hate to get political here, but
oh my God, no, that's not good.
I'm going to say this because I thought this was Trump's best idea that I've heard in a long time. He basically said months ago that he thought it would be great that when somebody graduates from one of our universities, a foreigner graduates from one of our universities with their diploma, they also get a visa. So basically, we don't train or educate somebody from another country and then send them back to compete with us.
Not all degrees, though.
Not all degrees.
No, there's just quite a few degrees where I don't think we should just.
I agree. Some of those degrees we don't want. Like, no, go back.
You make a list. How about we do that?
You get my point. And unfortunately, I think there are people that are very powerful that have convinced him that might not be the thing to do. And I think that was a great idea, and I hope he comes back around to that idea.
Well, the U.S. is going to have to completely overhaul its immigration policy because of this problem that we're facing. First of all, we've learned that immigration just let run loose doesn't solve this problem, right? We've not only seen it, we've experienced it, but then at the same time, going the other direction and saying, we're not going to let it, that doesn't solve it either. And it's time that we're going to have labor crisis and they're going to be forced to do something where it's like, we have to fast track this. We have to create incentives to get people in here to stay, and huge amounts. We're not talking about.
But if I feel like we're having two different discussions, like on the one, not to bring it back to the AI thing, but where everybody's talking about how freaked out everybody else, we're going to lose all our jobs. What are we going to be doing? That's like one side of the argument. And then the other side of the argument is like, we have a labor shortage. We need more people. And it's like, it's these two competing arguments of like, which one is it? Is it we're going to be losing all these jobs so we don't need that many people, which sounds like that's not a bad thing because we're already pretty tight, or is that not really true and we really need more people? By the way, the number is 2 million. So it's about half the amount of people are joining the work labor force than they are actually leaving. So there's still a huge gap on the delta.
I think the assumption that most people make is that the jobs we're going to lose to AI are the less skilled jobs. So the lower end jobs. No, I know, but I think a lot of people still believe that because that's what happens with most innovative revolutions.
Advances.
Yeah, with most technical advances, it's the lowest skilled jobs that go away first. And so we saw that.
AI is taking out high skilled jobs.
Exactly.
Well, like when you say high, like I would say medium high, because like
underwriters, for example, underwriters, you don't need underwriters. In 2 years from now, underwriters will be like, you don't even need them.
Perfect. I would love to not have a job.
and I would love to only have to work with an AI.
But seriously, like think about the underwriting. Like you guys are underwriting this stuff all day long, and that you're going to be able to just upload all your freaking data to some AI, and the AI is going to spit out based on your template of the way your philosophy
you like.
is.
The problem is, and I think this actually is a good, like maybe a different discussion, but the problem with AI is it's 99% accurate. But when you're underwriting a $30 million property, you have 300 touch points and inputs you're doing there. If it gets 3 of them wrong, then all of a sudden you offer 3 million more than you should, and that's
understood.
problem.
But that's today. It's like the stat that I saw not a couple of weeks ago, or maybe I forget who it was, but it was like that. Basically, AI can at this point do like 95% of a public filing, like the the Reg 8 type filings. I don't know if it's 95% on this indication, but it can do 80%. Now, 80% isn't good enough. Like you can't just do on that on your own. But tomorrow it'll be 85, and then the next day it'll be 90.
But
and
if it's 80%, Mauricio, then you don't need 4 people.
Exactly. That's my point. That's my point. And you can do it really fast. So instead of having to have 4, and again, I'm just doing it on my own sub. Instead of having 4 lawyers, you can have 1. And so these are a lawyer is a high skilled person, an engineer, a coder. These are high skilled labor that you're just not going to need them anymore.
I'm not going to need them. Have you seen Cactus? I don't know if you guys have ever seen that. It's an underwriting tool, and it does for real estate, but it takes in, you basically have the structure, then it includes AI does the automatic polling of all the data, right? And so you have the inputs, you put the number in, and then AI is pulling everything from taxes to all stuff, pre-filling, and it's making it all about. It's absolutely amazing. And if anybody would like to invest, you can go and jump into one of my funds with Cactus that I happen to.
AJOsborneCactus.com.
All right, that's a good place to wrap it up. Because I've been trying to find a way to transition to this next topic, and I haven't been able to do it because we're talking about treasuries. We talked about it too early in the discussion. We got off track with the job. So we mentioned last week that there was a historically low demand during the 20-year Treasury bond auction, and that spiked the rates, and it led to questions whether American treasuries were in trouble and there was no demand for foreigners to buy these treasuries. Well, last week, the U.S. Treasury announced a $10 billion buyback of its own bonds, the largest of its kind in American history. The last largest was back in 2000, which was $3 billion. Many people believe this is the Fed acting worried about systemic risk, while others downplay its effects. So, AJ, I'm asking you as a real estate investor, all we really want to know is, does this mean that the Fed is going to help us out in keeping these rates in check, even, or not the Fed, if the Treasury is going to help out in keeping us with these interest rates in check, even if the Fed doesn't?
No.
All right, then. Thanks for joining us. We'll be here next week with another episode of Drunk Real Estate.
Welcome. I love all the hype and everything. It's actually less than it was last year. So this has been going on for a while. And for some reason, people pick up on news. And then it's like, oh my gosh, this means something. I'm like, what? This is not new. And so this was started, what's it, 21 or 22. And a lot of this was started due to the fear or the worry about manipulation. And so it was created to offset volatility in the marketplace.
AJ, before you go, wait, let's describe what we're talking about, though. Go high level. What exactly are we talking about here? We're talking about the treasuries or the feds buying bonds?
The Treasury Department is buying bonds. So
it's like QT or QE light.
Yeah, exactly. It's QE, but it's not QE because it's not the Fed, it's the Treasury
and they're buying, and what the Fed normally does is they buy new bonds. The Treasury is buying bonds that exist to take them out of circulation.
Bingo. They're soaking up the market so it stabilizes it. And so when that came out, people were like, that's a sign of weakness. Or that's not. They've been doing this for a long time. They actually.
Well, it's also too because Bessent, the head of the Treasury, that he hinted back when we had that, back around Liberation Day, and they asked him about, okay, the Feds are not going to lower rates. He kind of hinted that the Treasury could, I think he used the words, flex their own muscular toolkit to potentially dial up its Treasury buybacks and have a similar effect. So he made that comment. So it's not like people are coming out of this from like left field. Like,
and AJ, where does the Treasury get all of this money to buy back their bonds?
They've been saving. They've been very frugal, and they've been stocking up for rainy day funds.
Interesting. They're pulling from their sovereign wealth fund, probably.
That's right. Yeah, this is classic government expenditure, which is a whole nother argument about government using its money, buying, and then bringing in bonds.
Treasury basically gets its money from one place. We pay our taxes, and our taxes go into a bank account, and the Treasury can use that to pay expenses.
And these are legitimate questions I think people would have, which is, okay, hold on a second. I get it. So the government gets their revenue from taxes and everything, but right now we're short. We're trillions of dollars short every year. So we have to actually issue bonds to make up the difference. Where are we getting this money to go buy them back?
The Treasury has decided that they would rather buy up existing bonds and issue new ones than save that money for other stuff and leave the old bonds out there.
And are they buying different maturities? Is that why it's?
Sorry, I'm jumping in, and this is AJ's. He knows more about this than I do, so I apologize.
So the bond buying program that the Treasury has done, it is different from QE. QE is meant to substantially bring those down. It is taking out of circulation bonds that never hit the market, and so it artificially lowers interest rates. The Treasury is buying up the market, and it is trying to stabilize it. So what happens is they did it. So during the last 4 years, particularly, it was right. Yeah. The last 4 or 5 years, China started offloading bonds like massively over the last 4 years. Like they just started dumping bonds. And that's why we saw this peak in 2024, where they're buying up bonds. They don't want the market flooded, and they don't want bad actors to be able to manipulate and change that. What Bassett was saying was that we could expand that, especially back to previous levels where it had been. I mean, you got to remember over the last 5 years, China was dumping a lot of bonds, like a lot. And so it's a stabilizing thing. A lot of people are saying then, why don't they utilize this to then act as QE? So why doesn't the Treasury just go and buy up mass quantities of new bonds, right, as well as existing, and monopolize the market? And there's a few reasons for this. First of all, it doesn't mean that they're not going to in some way, shape, or form. But the Treasury is different from the Fed in a lot of ways, particularly the fact that it borrows money, right, on taxpayers' dollars to have different functions. So if the Treasury decides to go do that, it's taking that decision away from other things. And so that obviously is a problem, where you have taxpayer money. We have certain things we want it to be spent on and spent for. And if you're buying up bonds to lower interest rates, you're shifting that around, right?
And can I point one other thing out that I think is pretty important? Normally, the Treasury can spend money on whatever they want because worst case, if they spend too much money and we run out, they just print more of it. But right now we're in the situation where there's the debt ceiling limit that hasn't been resolved, and at this point, the Treasury cannot print any new money. They're not authorized to do that. So if they run out of money at this point, we're screwed. And so making the decision to spend that money on bonds today is a little bit riskier than, I'm not saying it's the wrong decision to make. I'm not smart enough to determine that, but it's definitely riskier than it would be in normal times because we don't have a lot of money to play with until the debt ceiling issue is resolved.
Yeah. So they have a weekly, about a $4 billion cap. And that doesn't mean that they necessarily are hitting that. We're right about, what is it, 200 billion that they've taken out through 24 and part of 25. And their plans are to continue what's been going on, still at a lower rate than 24. But the question is that going to change? Right. And what I wonder if the statement is more a hint to try to drive QE and say, try to push the Fed along, like we're going to do this. If not, it also, I think, has a lot to do with the bill that came out and the spending package. So they're trying to see how they can be more involved because it's a little bit of bypassing the Fed. Now, it's once again, they're not doing anything, though, that wasn't done and hasn't been done. They're still buying less than they were.
Are they targeting? I couldn't find anything on this, AJ. Are they targeting any specific ones?
Yes, short term right now. So during the Biden era, they were targeting long term.
So isn't that the opposite of like what they should? Because right now we're having problems on the long end, right? Like
it's who's selling. So this is an issuance. So like when China was dumping over the last 4 years long term, that's who the Treasury needed to buy those to stabilize the markets. So a lot of it is not necessarily to get the output, right? It's just where we're having a surplus that would create unstable markets.
I guess I would think that one would affect the other, it would still affect issuance, even though they're not directly buying the issuance. I would still think that if we're having problems in the long end for issuance, then that's what you would still target on the back end too.
And I think that's more of what they were talking about. It was to do that a more targeted approach, whereas it's more market stabilization. The Treasury would take a more direct involvement and targeted approach to work on interest rates.
Because we actually, so if you want to bring up issuance, like we just had everyone was all worried about foreign demand for issuance after the 20-year and all that stuff. And we just had a 5-year Treasury auction, and it was the largest demand of foreign buyers in history ever. So it's not like foreigners don't want to buy U.S. Treasuries. It's just like people in general, I think, are scared of the long end right now.
Yeah, they're buying them at huge amounts. And two, offloading, like people are like, people are dumping our bonds and stuff. They're buying them. And actually the rate of dumping bonds has slowed. So over the last 5 years, we've seen a slowdown in that. Now, there is a direct correlation with the overall yield and the buying back. So it is not tremendous, right? We're not talking about like huge amounts. It more shows a stabilizing of those rates where once again, it's not as, you can't be that active, but they can bring it down and taper it in the short-term spikes that may be happening in those markets. And this has been a very powerful tool. Okay. This is, as far as government working within markets, the Treasury, the government has very little it can do to affect those things. This is one of the few things that they are involved in and can do to affect the supply and demand of those bonds. So
This makes no sense to me. So somebody needs to explain this to me like I'm a golden retriever. I'm a 2-year-old.
Hey, don't insult golden retrievers.
I have 2 of them. You know that. So the government is short almost $2 trillion right now every year. Right? And in order to make up that difference, to go do things with it, right? To pay the debt, to pay the interest on the debt, to pay our military, do all that we need to do, Social Security, it has to issue. By the way, Jay, I'm going to take issue with your comment about it just prints dollars. They don't print dollars. They print bonds that they sell on the market to get the dollars. So it's like they have to issue or print 1.9 or $2 trillion of bonds to get the $2 trillion to spend. And so you're telling me that they're taking some of that $2 trillion that they just issued bonds with to go buy back 30 billion or whatever, 30 billion or whatever of bonds. That makes no sense to me. Like, it's like you're issuing bonds, you're flooding the bond market with treasuries because you need to, but then you're using some of that money to buy it back, and somehow that makes a difference.
Here's a way to think about it. You live paycheck to paycheck. One day you want to go out and
Don't tell people I live paycheck to paycheck. That's not
okay. Well, so a guy named
Mauricio.
Mauricio Barul lives paycheck to paycheck,
I can barely make AJ's jet payment for him. Okay, so
and let's say every year you spend more money than you have. Like, you're going into debt every year. Every year you're putting $30,000, $40,000, $50,000 on your Amex. Exactly. You're living in debt.
I'm living. I got the black card. I'm good.
But the black card's only at 5%, so you're okay.
All right, cool.
Now one day I come to you and I say, hey, I need you to answer some legal questions for me, and I hope you don't make fun of me for doing so.
Do you have questions about third-party verification?
Exactly. And I pay you $5,000. Suddenly you've got this a bunch of money in your bank account, and you're like, woohoo, I'm going to go spend it all. So in theory, you're not going into debt when you spend this $5,000. But since you're in debt, that's basically what the Treasury is doing. They got a whole bunch of money from paying people paying their taxes the last couple months. So something like $3 trillion. And so now they're going out and they're spending this money as if they have plenty to play with, and they do have the money in their bank account. They're not creating new bonds to do this right now. They just happen to have a lot of money in their bank account because they just got paid their once a year big payment.
April 15th only happens once a year.
I had to borrow from my Amex. I'm just basically using that $5,000 to pay part of my Amex card back.
Yeah, 100%.
This becomes the problem. So first of all, the reason why we see spikes. So do you remember the chart that I showed you that showed government spending, how it offset the interest rates went up and inflation kind of came down, but it wouldn't budge anymore and we didn't have a contraction. And so I built that visual out that showed how government spending offset all the benefits of high interest rates. And what happened was the government changed how it was using its money in a lot of cases, right? And some of that was that they were using certain type of money to go into things like this. That meant with spending, guess what they had to do? Because not all money coming from the government is inflationary. If you take $1 from taxes and put $1 in the economy, that doesn't increase the money supply. But if you take $1 from taxes and you buy bonds and then you borrow money and use that into the economy, you increase the money supply. So what happens is you're increasing the money supply and offsetting it. It's short-term thinking, but it's not, you're still borrowing it. You're right. You're borrowing the money for other activities. I'm using the cash here.
It's like if I've got $1,000 payment to my Amex, and then I'm like, I'm going to go borrow $1,000 from the Amex so I can pay the Amex. Like,
well, but Mauricio, what if the point? How about we think about this a different way? How about we think about Jay pays you that $5,000, but he says, "Hey, I'm paying you that $5,000 not for your services, but because I need you to pay your partner in 2 months." So instead of having that money just sit in your bank account because it's not really, you can't pay down your debt or anything with it, you invest it in something that is paying a percentage point, and it's actually better than sitting in the bank account.
This is crazy. I really thought I understood this until we started the conversation. Now I have no idea what's going on.
So look at this. Mauricio, during a certain period of times, China was buying up bonds, then they were offloading bonds. Okay. So you can see that during 2001 to 2008, they were a massive buyer, right? They were buying and buying and buying. And then you had during 09 to 16, and then they started to sell in 17 to 20. But then in 21 to 25, they started to sell a lot. Well, this isn't issuance. They're not issuing new bonds. So as they're selling off these bonds, you're flooding the market, supply and demand. So the Treasury then is stepping in and saying, we don't want to shock the market, so we've got to step in to stabilize. So during certain periods of time, like the last 4 years, they had to buy a lot more.
But here's the issue I'm having. Like, let's say you have, to your point, great analogy. So China is unloaded their bonds. We could argue why, because I think there's a lot of misunderstanding to why they're doing it, but that's a different issue. They put in 100 bills into the market. So now there's 100 extra bills. So the U.S. could just borrow 100 less than they would have to make the same effect of buying those 100 in the first place, because they're issuing 1,000.
Out of two different departments, though, Mauricio. You can't expect them all to talk.
So the difference is it's they have a bill coming due. It's like if your Amex is coming due, then it's worth it for you to take that money to pay off part of your Amex.
We're talking about the float. We're talking about the float now. It's like I've got little floating action.
No, it's a budgetary issue. They have cash so they can buy it when the things go awry. There's all of a sudden China's dumping. We're using our cash. That means we have to borrow money then to pay for it. Why? Because you went out and bought something with the cash that you had, Mauricio. So now I have to borrow more money because I'm short.
So you're saying I'm issuing brand new bonds, but in order to buy old, existing, soaking up in the market bonds, like secondary bonds.
Part of it, yeah, they are, because they have to stabilize it or else it'll crash. So it's you're talking to the Fed, everyone, right, is not the government. The Fed's not the government. They issue. The government, though, is the one that borrows money for expenditures. They're trying to stabilize markets when somebody floods the market because they need to sell or whatever else it is. They use cash on hand. They increase debt limits to do all the other spending by, yes, I know, issuing bonds. It's the difference is in the market versus newly created.
Basically, you're paying down your high interest Amex, and you're taking out 0% interest Visa for 6 months.
I'm surprised AJ hasn't gone there yet, but I think it's probably because you talked about it several weeks ago, and you've put out a lot of great content on this concept of like, we have what percentage of our debt has to be refinanced, and so right now we're refinancing at not all time, but very high interest rates. And so it's in our best interest, the Treasury's best interest, to
if we're going to pay interest payments to someone, I guess it's probably best to pay to ourselves, right?
Bingo. So I have a choice. If I let this go, and you saw in the chart that I showed the spread where interest rates kind of came down. But when you are selling your debt, and you have to like reissue it, and those interest rates are going up in the short term.
If they knew that they were going to lower rates, then they could go buy a bunch of bonds at higher rates, then lower the rates and flip those bonds and make a bunch of money.
That part makes sense to me. Like, you can issue money at whatever 4%, go buy these bonds so that you lower the rate so that tomorrow you can now borrow, because you've only got to refinance it in a short period of time. It's not like forever. It's like you're artificially,
the bond market broke.
Yeah.
And interest rates went up. And that's why all of a sudden it's like this huge colossal problem.
And nobody's talking about it.
They've been buying bonds and reissuing at lower rates for how long now?
So, but AJ, like all of us real estate investors, we were saying, oh, this is perfect. The Treasury is going to step in and they're going to bring interest rates for us. They're going to bring them down. And you're telling us that's not the case. It's
not the case. It will not have. If it was the case, they may try to make it the case, but look what we saw in the last 4 years. They were able to stop interest rates from going higher. But even with that mass amount of buying over the last 4 years, they did not get to really lower rates. They just stopped it from going higher. If the Treasury wants to step in and lower rates, that is a very different game than what they're doing now. They're going to have to buy at very, very large amounts. And it will be different than stabilizing market of bonds that people are selling and trading at any given moment. they have to buy up market new issue.
I'm surprised the Fed's not
That's
stepping
different.
in and buying more bonds to get those interest rates down. But a solution to this, Kyle, is even though interest rates may not come down, you should just use the AI underwriting because that'll make the numbers better and you'll be able to make better offers anyway.
Tell AI you want better numbers.
Tell AI we really
you
need to get a property, and it will be like, okay, I'm going to fudge the underwriting to make it work, and then we'll be great.
My question, though, to you guys is, do we think they're going to step in and go, we're going to spend $1 trillion to buy up bonds? The Treasury is going to go out and say, hey, everybody, we tried to lower interest rates this way, like the Trump administration. They're trying to force the Fed. They thought they'd get lower. They're not getting it.
It's not actually like when you think about it that way, like that. If they're forcing interest rates down, they're buying an asset and then they're forcing appreciation. They're basically value adding bonds.
How much are they buying though? I saw the number. Like, how much are they buying? Like, is it 30 billion or am I way off?
10 billion.
It's
10 billion.
Yeah,
What's
10 billion right now.
What's the global treasury market? Like, how much?
Oh, geez.
Right,
It's ridiculous. It's such a small amount. I haven't quite
10 billion into the global treasury market is like
I
maybe
have
per
not
day.
figured out why this even made headlines. I'm sure it makes sense.
I told you why it made headlines. It's because
So it's hundreds of billions that they're buying. The idea, though, is this. Are they going to step in and spend $1 trillion? That will absolutely have an impact if you take out $1 trillion of bonds on the market. Like, that'll have a very large
Besson, and Besson said he could do something like that, and this is the first indication.
They're going to have to flood the market with $1 trillion of new bonds in order to get the $1 trillion to go buy the $1 trillion in bonds because they don't have $1 trillion.
That's why the spending package, and once again, the whole thing was up. So all this, and that's the whole point. Is can they game the system? Can they literally do it? So they're issuing debt and they're buying their rate down essentially because of this ticking time bomb of $10 trillion that has to be refinanced.
That's a legitimate. That's the part I'm surprised is not making the headlines. That a third. I think it's actually. I thought it was 12. Like a third of our national debt. So our national debt is 36 trillion. So a third of that's about 12. That's coming due over the next. You tell me, AJ. Remember, is it over 12 months? So in the next 12 months, we have to turn over a third of our debt, which our average interest rate on that is like 2.5%. Now we're turning that over at whatever interest rates are today, 4.5%.
It's over the total spending of defense for the United States. It will be the largest expenditure of the United States. Will be interest.
Yeah, but next May we know rates will be lower. Like I'm surprised that hasn't been factored in yet. We know.
What do you mean? You know? What do you mean?
We know 100% next May.
If it's 100%, you'd be retired as a billionaire in May.
No, we know. What I'm saying is we know that in 100% in next May, Powell is gone, right?
So Trump will put somebody in that
and
is
Trump is going to put somebody in, and I guarantee whoever he puts in before he nominates them, he's going to be like, "Look, you're going in here, but you're lowering interest rates," and he's going to be like, "You got it, boss." So we know next May they're going down.
What interest rate do they control? They only control the overnight rate. And they could buy bonds to get the rates down, but it's not
he's going to have Bassett with the Treasury, and then he's going to have a lackey at the Fed. And
So, no. Let's be clear. There was talk just a couple hours ago. Breaking news. So Scott Bessent, not Bassett, Scott Bessent, the Treasury Secretary.
You said Bessent, I said Bessent.
Is likely to be the guy who ends up running the Fed next year.
So what is he going to do?
That wouldn't surprise me at all.
So he drops interest rates to zero. You think the 10-year bond goes down by 4%?
Well, he can't do anything by himself. I mean, the Fed, there's a committee of, 17, 18, 19 people. I forget exactly how many. And they vote on this. And so certainly he's the most powerful. He would be, or whoever is the Fed president or chairman would be the most powerful person on the committee. But that he can't make unilateral decisions.
The question is the Fed, right now the Fed is walking a tightrope where they're saying, we think we can do this. If the bond market doesn't play along, will they step in? So are they just going to let the United States blow up? So like if all of a sudden we have these new issuing bonds and interest rates start going up because the bond market will not absorb all these bonds with 10 trillion rolling over, but then we also have, 4 trillion they've got to get for new debt. And we have a market that won't absorb it. And so interest rates start to rise dramatically to entice investors to buy bonds. Will the central banks literally just let interest rates go up to lock in the United States for trillions of dollars of interest rates or that paying on interest, or will they step in and do QE to try to lower it? And that's the question on everybody's mind. Are they going to do something about it to save the United States? Or are they just going to go, we think you'll be fine.
Why don't they have a planned rate lowering where they just do QE, buy a bunch of bonds, all at very high rates, and then immediately drop the interest rate by 1% and then sell them all. And then we could make all our interest payments.
They should game this thing.
Why not? Am I ever like happy for someone gaming the system, it would be the government to pay their bills, right? It's better than rich people.
But this is the debate that everybody's talking about. Central banks and the Fed, Trump screaming at them, going back and forth. We don't have to listen to him. We're going to do our own thing. Well, you can, but you're going to screw us. This is this central banks and the governments going at it right now. And the market, I think, is gambling largely one way or another. So when the news of this stuff hits, the market swings dramatically because everybody's waiting around. Everybody thought interest rates was going to go lower, which we talked about. I was like, that's just not absurd. And then they couldn't. At some point, do they say, we're going to try it and not have inflation? We're on a tightrope right now, honestly, for the United States.
I guess most people think it's a pretty long tightrope because, as I said, the short end of the curve still has a little bit of confidence. It's that back end. But all right, well, that sucks. Rates aren't coming down on $10 billion. Nuts.
It's hundreds of billions, 10 billion like a month or something, but still they need $1 trillion.
Right. Okay. Should we do it? I'll do a top five. How about a top five? I thought it was interesting. Where Elon Musk has been in the news a lot and how he's the CEO and founder of a lot of companies and how kind of rare that is actually. And you don't.
AJ does that all the time.
Well, but I guess the point is that it got me looking into this and the fact that once a company gets big enough, most of the time it goes out and hired guns as CEO. But there are a bunch of major companies that the founder is still the CEO. And I think the reason people think it's a prevalent thing is these are some well-named people. So I'll let you guys guess. I'm going to do the top five and let's start throwing out who you think the top five founder run companies are.
When you say top, what do you mean by top?
Largest.
Largest.
Mark
Zuckerberg.
So Warren Buffett.
Elon Musk. Warren Buffett. Well,
Warren Buffett is not a founder.
Okay, so you got Zuckerberg, you got Musk. So actually, we have Nvidia, Jensen Huang.
I said Bezos, Musk.
But Bezos isn't a CEO either.
Yeah, so Bezos isn't the CEO either.
He left too. Yeah.
We still have because otherwise you would have had what's his name from Microsoft too, Gates, but he left. But we still have Dell, Michael Dell. Still the CEO of Dell Technologies.
Who's the guy that owns the Hawaiian island?
You talking about Branson?
No. You mentioned him. You already said that.
Cisco?
Emerson, not Emerson.
All right, then we got. So next up, you're only missing one, and that's actually the guy from Capital
Ashley
One.
Wilson. Oh,
yeah, Capital One, Richard D. Fairbank. But I did want to throw a shout out. BlackRock. They're not one of the top ones, but they made, I think it was top 10. And Lawrence Fink, founder and CEO of BlackRock, who we talk about a lot, obviously, with the whole real estate connection. There you go. Founder CEOs. And
that was a good one.
Yeah, I like that.
Because a lot of people don't realize the vast majority of CEOs are not founders. Almost always founders are kicked out by the board. They have to go because founders.
Theoretically, we could have one more in Apple, but obviously he passed away. So I would have suspected he wasn't going to give that one up. But yeah, Jay, you got any hypotheticals for us?
I don't. I'm actually looking right now. Don't have anything good.
Nothing good.
Nothing good. No. Do you have anybody?
No. let's just wrap it up then. It's a long episode anyway. Mauricio, you got a plug?
I am plugging my Elite. I've actually changed the name. Now I've changed it to the Elite Syndicator Inner Circle.
Ooh,
If you want to get
okay.
weekly guidance on syndications, join our weekly calls. Just go to coachingwithmauricio.com and come join our weekly calls. Not for less than a cup of coffee, but pretty darn less than.
It's
Have you seen the price of coffee recently?
It's like
Starbucks.
It's less than the price of eggs. Let's put it that way.
Or it's just give Mauricio a follow just to keep up with the name changes. It's like HBO, like HBO Max.
I'm almost at
Max.
7,000 on LinkedIn. I'm getting excited there.
Ooh, wow, that is a number.
Yeah,
I don't even know. I don't think I've been on my LinkedIn.
dude, I'm a LinkedIn guy. I'm all over LinkedIn. I post LinkedIn daily, sometimes twice a day.
AJ, what do you got?
There's a lot going on. We've got our inner circle that we've got.
Are we going to do this? Are we going to do this thing again where you're going to be like, talk about one thing and then be like, oh, I forgot the other thing. And you're going to get multiple plugs in.
I can't decide if it's the YouTube or if they should go get those threads on Twitter or should go to Instagram and get the video. How am I supposed to decide which one?
All right. What's the final decision? What's the one? YouTube channel. Go check out AJ on YouTube. Hey, and yeah, drop a comment. AJ and I were shooting the and I want to do a 3-hour Joe Rogan interview of AJ. I want to sit down with him and dive into his life. He's got an interesting life, and I want to do a 3-hour. So if you want to do that, then
By the way, before we get to Jay, although maybe I should ask Jay because we technically didn't have any winners to the question of the day 2 weeks ago, because the same gentleman won again. I already gave him a book, so I'm not giving it to him again. But nobody was able to guess. Nobody was able to really guess what World Series of Poker event you made the final table at. What event and where did you come out? So give it away, Jay. What was this?
So it was actually almost exactly to the day 20 years ago. It was 20 years ago, a couple days ago. And I posted the link to the video. So I was on ESPN. It was
ESPN 8, the Ocho.
No, this was the main ESPN. They used to cover the World Series of Poker. So if you want to see that ESPN episode, it's on my Facebook. I linked it up there. But it was event number 3 at the 2005 World Series of Poker, the $1,500 limit hold'em event. And I took second place to a guy named Eric Froelich, who at the time was the youngest World Series bracelet winner in history. At the time, it was the single longest final table in World Series poker history at 17 hours. And it was the longest heads up in World Series poker history at the time at over 5 hours. So we started at noon, the third day of play, and we played until 7 a.m. the next morning.
Jay, that was before the whole revolution. I think that was before was that before Moneymaker or after Moneymaker?
That was a year or two after Moneymaker.
After, so like, you don't have to give me the exact dollar, but everybody wants to know, like, $1,500 buy-in. What does second place take? Is this like, are you like hundreds of thousands, millions of dollars, 20 grand? Like, what are we talking about?
I'm happy. So you can find it online. So interestingly enough, there's a scaled pay grade.
I'm just looking for a number, Jay. I don't need a TED talk.
But it's interesting. So I normally I would have been entitled to $182,000, but when it got heads up,
you guys split it, right? You guys
we didn't split it, but we walked away from the table and we negotiated based on our chip counts how much we would each take, regardless of the outcome. With the only thing decided at the outcome is who would get the bracelet. So it was agreed that I would take $240,000. He got about 400,000. And so even if I would have won, he would have gotten 400,000. I would have gotten 240,000, but I would have gotten the bracelet.
That's awesome.
That is a great story.
That's really
and
cool.
That's how Jay started flipping houses.
All of that money to fund, you started that, you started bar down investments with that $250,000 investment, right?
I know. He bought his first flip with a $250,000.
I put it all on black. It came up red.
Well,
right.
Jay, let's try again. I'll come down, pick you up, and let's go to Vegas.
There we go.
Now that I know you're good, let's go.
Jay, I think you got a decent plug this time, though.
I do. Mauricio, can you throw out a disclaimer for me before I give my plug?
What kind of disclaimer, that you don't know what you're talking about, or that you?
Yeah, whatever disclaimer I need. I'm about to.
Past performance is not an indication of future.
You're about to plug. Yes. The following announcement is for accredited investors only. This is a 506c offering. This is not an offer. You have to review all of the offering documents, including the private placement memorandum. Check with your lawyers and your CPAs and your financial advisor, and don't take this as the gospel. And just it's for educational purposes only.
Yeah. And let me throw in one more. Past performance, no matter how awesome I have been in the past and no matter how awesome I am now, doesn't necessarily mean that this deal is going to be
We
as
actually
awesome.
say that when past performance has been really good. So I'm not sure. Is that relevant on this one?
Okay. So it's been 3 years. But Kyle and I and Ashley Wilson's husband's wife, Ashley Wilson. So Bar Down Investments, we have our first big syndication in 3 years, not for lack of looking. We've been looking for a deal for 3 years. We make lots of offers, but we found that needle in a haystack. It's what we believe to be an awesome deal. 351 unit ground up new construction outside of Dallas, Texas. So anybody looking to invest passively in this 506c, meaning you have to be accredited, deal, reach out to me. You can find me jscott.com, or everybody can figure out where to find me. But minimum investments is, we say 100,000, but if you're investing with us for the first time, I'll probably go down to 50 for you.
And how long is it going to be open for?
We are about 50% full in less than a week. So I expect it to fill up pretty quickly. But we probably have another week or two left. So you don't have to call me in the middle of the night, but don't wait too long.
Yeah. And everybody, you're listening to this obviously later. And so by the time this comes out Thursday or Friday, the weekend, so you may not have to break down the door, but don't wait.
Appreciate it.
All right.
Nice to have a deal to pitch. Wow. We've been doing this podcast. We're up to episode 99, and this is
the whole
first
idea.
deal
We
I've
got
had
this
to pitch.
podcast. We'll be able to pitch deals and stuff, and then we just didn't have anything.
Market tanked.
Are we doing episode 100 next week? Is that what's happening?
Whether we like it or not.
Give or take. It's a 50-50.
So are we going to do our conspiracy theory episode?
Hey,
Oh,
guys,
we should.
Mauricio, I'm doing it with you.
Right.
Episode 100. Let's go to Newport, guys. I'm going to be there.
Nice. He's going to be in Newport. Let's do it together.
Mauricio, let's do it.
Rhode Island or California?
No one wants to come to California right now. They'll get shot with rubber bullets.
We're not going to LA. We're going to Orange County. We're okay.
Although, dude, Newport Beach is where I was. So I tell this before. I was going to do Father's Day on Monday or on Saturday, and we're going to have a nice little restaurant at the mall, and they're doing a protest right next to the mall. So we're changing plans. So yeah, I don't know exactly where in Newport Beach you're going to be, but we got to be strategic.
Wherever it is.
Should we all
you
just
let me
leave
know
for
and we'll
Father's Day? Just like that's what fathers do, right? Leave their families for Father's Day.
We record on Tuesday. We don't record on Sunday.
I now understand a lot about your history and childhood, Kyle.
My parents listened religiously. They were very good parents. They didn't leave me at all. Especially my dad schlepped me to every hockey game. So,
Dad, he does say great things about you. It's true.
All right. So episode 100, kind of a big deal. Everyone should tune in. I hope you all come, and
Let's do lots of giveaways next week. Can we do lots of giveaways next week?
Yeah. I've got lots of J. Scott books to give away. I got to get rid of them, so I'll give them away. They're not very worth. They're not worth much, but I'll give it to you.
Kyle's giving away some clear rum.
Maybe
give away books, coaching. Maybe we'll do it free.
I'm going to give away some coaching.
You can, Apparently my job's getting replaced with AI, so no one wants to talk to me. All right. Episode 100. Everyone come next Tuesday. I'll see you next Thursday.